Hello and welcome to our new investment strategy update. As we enter the final quarters of 2025, much is at stake. Monetary policy is lending a hand to the global economy as the Federal Reserve has restarted its rate-cutting cycle. But will this be enough to shield the US from a deeper slowdown? Or should the Fed be cutting at all, as the full impact of tariffs still lies ahead? The Fed faces a tricky balancing act. Consumption and corporate earnings remain resilient, but unemployment is creeping up. At the same time, inflationary pressures are rising. Weakening job and housing markets mean that financial conditions are still too restrictive, while a peak in inflation in the coming months should be contained. That's why the Fed needs to continue lowering policy rates. We expect 2 more cuts this year and then a pause. Ultimately, rates should reach an accommodative level of around 3% by end 2026. Now, for the global outlook, much depends on trade and how much tariffs then grows outside the US. While most tariffs are lower than initial threats, they look set to stay. They now provide significant income for the US government, and legal challenges are unlikely to fully remove them, as the administration has other legal ways to impose them if needed. Additional US tariffs on China are likely to continue being postponed, as China's rising tech capabilities, and especially its dominance in rare earth exports, give it leverage against the US. At the same time, neither side is motivated to de-escalate strategic competition. We therefore expect the status quo to persist. A trade truce with the US, stabilizing inflation, and a steadier housing market are positives for the Chinese economy. However, momentum remains fragile and may not last without further government stimulus. Fiscal concerns in developed economies are also in focus, and much attention is on France, and the cost of French debt will remain high. But the ongoing political deadlock shouldn't trigger a financial crisis. The outlook for the broader euro area looks somewhat stronger, thanks to a meaningful fiscal boost from Germany, among others. We therefore expect no further rate cuts from the European Central Bank, nor in Switzerland, where inflation appears to have bottomed. There is little sign of progress on the 39% US tariff on Swiss exports. As for new pharmaceutical tariffs, most large pharma companies may be shielded as they have already made substantial US investments. Overall, Switzerland has other means to support growth, notably its substantial fiscal firepower, and we expect the economy to weather the storm. So how does this translate into our investment strategy? Well, markets remain resilient, but major economic challenges demand vigilance. US equities have repeatedly set new records, driven in part by technology stocks, optimism around artificial intelligence, and capital investment. We expect US tech to continue generating earnings growth, though at a slower pace. And with US valuations now stretched, we have slightly reduced our allocation to US equities. Crucially, the equity rally is broadening, and as we approach third quarter corporate reporting season, we see improved prospects for healthcare. Here, a lot of negative news is now priced in, and earnings expectations are rising after months of policy uncertainty. This return potential extends to Swiss stocks, leading us to increase our exposure to overweight levels. Globally, we remain overweight in equities with a preference for emerging markets over developed markets. These offer higher earnings growth and lower valuations. In fixed income, we maintain our global allocations at overweight levels. We expect the US yield curve to steepen as short-term bond yields fall faster than longer maturities. Moderately lower US yields support fixed income across the board, but we see the strongest balance of risk and return in investment-grade corporate bonds and emerging market hard currency debt. In currencies, we keep a cautious view on the US dollar. Although markets have long anticipated Fed easing, it comes as other major central banks are holding rates, or in the case of Japan, raising them. We prefer currencies of countries with healthier fiscal profiles, including many in emerging Asia. Finally, we have increased our allocation to gold. Gold has clear upside potential in an environment of lower growth falling US real rates, a weaker dollar, and fiscal concerns. As the business cycle evolves, we focus on portfolio diversification and selective investment choices with a moderate pro-risk stance. Staying invested today means navigating changes with conviction and care as the global order continues to evolve at a tremendous pace. Thank you so much for watching.